So over the past few months, just about every investor has been talking about China. Some people say investing in China is like gambling in a rigged casino, while others believe it would be mad to not invest in a country growing as fast as China is. So, who's right? Should we be investing in China or not? Well, in this video, we're going to hear the thoughts on this exact topic from one of the world's top investors, Chamath Palihapitiya. We're going to hear Chamath's thoughts on how he sees the market today after China's recent anti-capitalist moves and whether he would invest now or not. Hi and welcome back. My name is Tom Heavey. I hope you're doing well. So I'm not going to make you wait. Instead, let's just jump straight into this first clip with Chamath. A quick note though, first you're going to see Jason Calacanis giving a quick recap of the China situation, and then Chamath comes in shortly after. Okay, let's begin.
The China situation has been perplexing to me. You know, my position was always be careful working in China or investing in China. We're investing in Chinese companies because they could change the rules at any time and change the rules they have in the past year. We talked about, obviously, Ant Financial and Jack Ma going MIA, ByteDance's CEO and founder stepping down as CEO amid Chinese regulations and all the scrutiny. And then we have Didi last week being pulled from the App Store in an unprecedented penalty where you're not allowed to download Didi and the existing users can use it. And then on top of that, all the educational companies this week were told that they cannot operate as for-profit companies. And these companies have gone public in Hong Kong and in the West. And this has caused such an acute effect. SoftBank is clearing a bunch of its Uber position to cover their losses in Didi. And then there is the story of Larry Chen, who is a Chinese education entrepreneur. He was worth $15 billion in January. Now he's lost 99% of his net worth. According to Bloomberg, he founded Gaotu Techido or Techido, which is a Chinese online tutoring firm. As we know, education is huge in China. That company, Gaotu, peaked at $140 a share in January and has fallen to $3 a share. Big sordid story there. Tencent lost $100 billion in market cap in 3 days earlier this week as China cracked down on what they called a monopoly in music rights. So while we debate what happens with the monopolies here in the United States, China just literally told them, and here's the quote from the BBC article, the company and its affiliated businesses have been told that they can no longer engage in exclusive deals over music rights and must dissolve any existing agreements within 30 days. I mean, this would be like Biden just saying the App Store is now open. You have to let other app stores in Apple, or, you know, just coming down and saying to Amazon, you can't sell Amazon Basics anymore in 30 days. No more Amazon Basics at the site. What do you think the end game is here? Is this because China seems like they are very deliberate and they plan in centuries. What is happening here?
There's the short term and the long term. I think what's happening in the short term is that the same thing that we are talking about in the United States that Sachs is, very eloquently, basically, I think led most everybody in just really framing for a lot of people is this idea that, we have privatized free speech and we have put the distribution of information into the hands of 3 or 4 founder CEO oligarchs. That's also true in China. And when you look under the hood of the major internet companies, there's 4 or 5 guys that are in charge. And so I think that in the United States, politicians feel increasingly uneasy with those folks having power because it's applied indiscriminately. Trump gets banned, Trump may not get banned, this person gets distribution, this article is considered misinformation, that article is considered disinformation, this article is suppressed. It's a dangerous place to be. And in China, they were just like, enough's enough. So I think the short term, as it relates to the internet companies, was basically a realization that we are not going to allow any more devolution of power from the Chinese Communist Party to and into the hands of these internet entrepreneurs. So that was sort of like the...
So it's a move out of fear. They're scared they're going to lose their power base.
Not scared. I think they're just smart, and they were like, we're not going to allow this to happen. So they don't have to deal with Section 230 or any law like that. I think it was just a realization that we want them to understand who is boss, right? And so there was a wave of resignations. There was now all of this market cap upheaval And this is now where we get to sort of like the appetizer. And I think in the appetizer, what they're basically saying is, we will control how money is made and who makes money. And I think that that sets up the really difficult thing that I think happens, which is about the long term. So in this thing, what's happening right now is China very firmly telling everybody, we are firmly in control. There is no private market and there is no capital market without our approval. And that's a really big statement. And in fact, it was such a big statement that I think the Chinese security authorities then had like a conference call at Goldman Sachs, JP Morgan, all these folks were invited. And, the vice chairman, basically, his quote was something to the effect of, we promise that any more changes will at least let you know. Not, hey, there's nothing to see here, or there's nothing more to come. It's just more that as we decide new rules, we'll make sure that we give you guys enough warning. So it's very much firmly saying, we know exactly how money is made. We will decide who makes money in what way. And we're going to make sure that, all of this wealth creation happens under terms that we define. And I think that the setup for the long term. The long term in China is complicated. It is an enormous demographic time bomb. We've talked about this before. By the end of 2100, China's population will shrink from 1.1, 1.2 billion people down to about 700 million people. Right? So they had very progressive, quote unquote, under their framework, laws of one-child policy to basically make it economically viable in the 60s and 70s. There was such a number of people. Those people were able to get great jobs in the 80s and 90s and 2000s. And now they've realized, oh, wow, we made a huge miscalculation because now there is just not enough people. And so China's going to shrink. And I think that, honestly, I think Xi Jinping probably thinks the simplest way to solve this is to basically nationalize a lot of the economy over time. And so if I was a betting man, which I am general, but I'm not in China because I just don't understand the market. It's super complicated.
It's a rigged casino. It's a stupid place to bet.
I'm not going to say that. I just think that I don't know the market.
Well, I mean, if they change the rules of the game.
Well, hold on. Let me just finish what I was saying. I think that what we're starting to see is the beginning of nationalizations. And I think it's going to start in technology universe because those are the critical assets that the Chinese need to own for the future.
But there's no more game in terms of building companies and investing in China. Like, how is the West ever going to trust? How is Goldman Sachs or Sequoia, launching a venture firm there, or retail investors or hedge fund investors? How are they ever going to want to participate in that market?
So look, for example, when you invest in China, right, or if you set up a fund, there are two pools of capital, right? There's the local renminbi denominated investment vehicles, and then there's the US dollar denominated investment vehicles. And they do that to segregate where the capital comes from. So it's not too difficult for the Chinese government to basically say, you know what, I'm going to actually make a constraint on dollar inflows so that, the renminbi denominated investment funds that are from Chinese investors into Chinese companies needs to be above a certain percentage, call it 2/3, right? Or call it 80%. They can make all these decisions because these are all just rules that are completely under their control. So I think that people who don't think this is going to happen are probably not looking at the setup. The setup seems to be directing itself towards that outcome. And by the way, it makes sense for what Xi Jinping wants to do from his perspective.
But that's not my question. My question is, why would Masayoshi-san or another entity ever invest in China again?
Because you look through the risks and you got completely enamored by the population and the TAM. But what I'm saying now is...
Well, why would they do it again? Or are they not going to do it?
No, but there are boundary conditions that would say that even before this, you would have had to reconsider. The population is shrinking. There's a different demand side pull that's happening, right? Older people need different kinds of services than younger people. There's not enough younger people. There's too many men. There's not enough women. So there's not enough couples. All of these demographic issues ultimately will get reflected in the economic reality, which is that smart investors would put money in China differently over time anyways. But I think that this is a bigger thing, as David said, which is if that's coming to pass, you want to control the pipes because you want to control how that information is presented to people, your citizens, so that they don't get pissed off. And then you might as well just own the economy, own the business anyway.
I see this as being amazing for American tech companies because I don't see who would ever want to be an entrepreneur, whoever has a great idea and wants to pursue it in China. Why would you do it?
No, I disagree with you. And the reason I disagree with you is...
And we don't have access to their markets anyway. What company has access to their market?
The difference is young, smart Chinese people for decades have been staying in China, in part because they could more relate culturally to Jack Ma than they could to Jack Dorsey. Mm-hmm. Okay, that just makes sense.
Sure.
And I understand that. And then the second is we, like the opposite of some other Western countries like Canada, closed our doors.
Why would the next Jack Ma start a company if they saw Jack Ma disappear? That's my question.
Because you know what? If you're coming from China and you can only make $1 billion versus $45 billion, I think you still take the shot.
I would come out in the middle and say they've just attached a discount rate that now every investor has to consider political risk when they invest in China because the future is very uncertain. The bargain is getting changed. And if you're an investor, you now have to taking some huge political risk.
I agree with David. I think that's a better way. I would refine what I'm saying by saying it's a distribution of risk where it's closer to Russia now than it is to the United States.
Okay, so when it comes to investing in China, there are basically two schools of thought. We'll talk about those in a sec, but first, regardless of which of the two you subscribe to, we have to recognize the reality that China has full control to change the rules of the game at any time. When you invest in America or Europe, you pretty much know what you're getting with capitalism. With China, though, there is a push towards nationalism, which can obviously affect your investments, as we've just seen. And as Chamath says, he believes China are on a path to extreme nationalism going forwards in the long term. So this is something which we can expect to continue. However, Chamath still doesn't disregard investing in China, which sounds quite counterintuitive, right? So why doesn't he? Well, there are those two schools of thought. Number one, you see the impact that China can have on the stock market and you decide to stay well away. Or number two, you understand the risk that China could change the rules and you factor that into your valuations. In other words, because of this additional risk, you pay less for a company or for a stock market index than you would otherwise. For example, if there are two identical companies in China and America, the company in America would be worth more. Why? Because there is significantly less risk of government intervention, of course. As a result, this drops the price of the Chinese company down. But at a certain point, as the price is falling, the company will become so cheap that savvy investors would begin buying it back up again. As an example, here we can see the PE ratio of China's stock market over the past 20 years. Now, to be clear, this isn't the valuation of the stock market, this is the PE ratio. So how much investors are willing to pay for every dollar the Chinese companies make. As we can see, between 2000 and 2010, the PE ratio is far higher than it has been over the past decade. And in the past 3 years in particular, the PE ratio has continued to fall. This demonstrates to us how investors have been factoring in this increased risk of government intervention. So we've heard Chamath's thoughts on China. We've heard why he doesn't disregard investing in the country. He simply believes that investors have to apply a different discount rate to Chinese stocks. In other words, they're valued less than an identical company in a different country. But either way, I'm interested to know what you think. Do you think investing in China is just too risky, or at the right price, would you consider Chinese stocks to get the benefits of diversification? Let me know your thoughts in the comments below. Thank you for watching, and I will see you again very soon.